4 ways to actually retire on SCHD. One mistake that wrecks all of them. Let's go. Hold 1 second on the number before cutting to section 1. Quick context. SCHD is the Schwab U.S. Dividend Equity ETF, a low-cost fund of high-quality U.S. companies with a track record of paying and growing their dividends. It's not chasing the highest yield out there. It screens for real fundamentals, cash flow, return on equity, years of dividend growth, then weights the winners. Translation: one ticker, a 0.06% expense ratio, and a basket of real dividend payers instead of yield traps. Your boring but reliable paycheck machine if you use it right. 4 ways to turn that into income. Here's the most common one. Real math. SCHD's yield moves with price, but it's currently running around 3.2 to 3.5%. Check the live number before you run this math yourself. On $400,000 in SCHD, that's roughly $12,500 to $14,000 a year before taxes. Upside, your shares stay intact, and spending the dividend instead of the principal feels safer. That's huge psychologically for a lot of retirees. Downside, if inflation runs hot or that yield compresses, your income might not keep up, and plenty of retirees end up underspending out of fear, even when their portfolio could support more. This works, but only as one piece of your income, not your whole plan. Want more flexibility than that? Strategy 2. Strategy 2, dividends plus a planned sell-down. This is the flexible version. You target a total withdrawal rate, say 4 to 5%, part from dividends, part from selling shares in strong years. Real math. On a $500,000 SCHD portfolio, if dividends cover 3.5%, you sell an extra 1 to 1.5% in good markets to hit your number. Upside, your withdrawals flex with the market, and you get a raise whenever dividends grow. The risk is behavioral, not mathematical. You need actual rules, or you'll panic sell in a downturn and overspend in a bull run. SCHD is still 100% equity. This is the strategy most retirees underestimate, and it's usually more realistic than pretending dividends alone will cover everything. Bridge. Don't want SCHD to be your entire retirement? Strategy 3. Strategy 3. SCHD as the income engine inside a bigger portfolio. Real math. Picture a $1,000 portfolio, 40% SCHD, 40% total market ETF, 20% bonds. SCHD covers a big chunk of the cash flow. The other 2 pieces stabilize the ride and drive growth. You're not betting your entire retirement on one ETF, one factor, or one strategy. If you like dividends but still want real diversification, this is usually the sweet spot. Every strategy so far assumes you're already retired. What if you're not there yet? Strategy 4. Build now, flip to income later. In your working years, reinvest every dividend and focus on total return. SCHD has 14 years of dividend growth behind it, plus a track record of pairing that with price appreciation. Then, in your late 50s or early 60s, flip the switch. Stop reinvesting and send those dividends straight into your checking account. Same yield, bigger share count, bigger paycheck, because you built the base before you needed it. Bridge, open loop payoff. Now here's the mistake I promised you at the start, the one that can undo all 4 of these strategies. Mistake 1, treating SCHD like a magic income number. One yield, one portfolio size, assuming the next 10 years look exactly like the last 10. Mistake 2, going all in on SCHD because it feels safer than it is. It's still 100% equity, concentrated in U.S. dividend payers, and it can lag the broader market for years at a time. And mistake 3, the one that actually cost me the most, ignoring where SCHD sits. Hold it in the wrong account, and you can owe more tax on that dividend income than you expect, especially once you stack it on top of Social Security. The ETF was never the mistake. How you use it is. Bottom line, SCHD is not one size fits all. It's your dividend paycheck, part of a flexible withdrawal plan, the income engine in a diversified portfolio, or the thing you're quietly building before you ever retire. The right one depends on your age, your other income, and whether you can actually stick to the plan when markets get ugly. Remember that $500,000 number from the start? I've got the full breakdown, $250,000, $500,000, and $1,000 portfolios, real numbers. It's the video on screen right now. Watch that before you buy another share of SCHD. And if you're already holding it, drop your number in the comments. I read every one.